Good morning, or good afternoon, or good evening, depending on what time you are looking into my lecture recording. Well, welcome to week 7 of our derivatives unit. Our topic today is trading strategies involving options contracts. In your textbook, it's chapter 12. How are you all, first of all? Are you all doing well? I hope and I believe that you all are doing well because I see many emails popping into my list to answer certain questions. I appreciate that. And of course, from time to time, we have our Zoom meetings. So far, we have completed the take home assignment one. I'm in the process of marking it. I'm very happy to mark it because many of you have done very well. Be inspired. Despite our shortcomings of this coronavirus and all these things, be inspired. You have a great future. Okay, let us go into today's lecture. The lecture objectives today to understand the rationale of key option trading strategies. Of course, you have learned in the last week that options are there available for you. Previously, of course, you have learned futures. We have learned also forwards. All these are derivative instruments, are contracts written upon some kind of underlying asset. But now we're going to see how to use option trading strategies that will benefit the trader. Either you are a holder of the option or you are a financial institution who are selling options. Either way, no one should go in a loss. The whole world wants to make a profit. People don't like a loss. So we're going to combine the options with the underlying assets and so on to devise strategies that can keep you floating only with a profit. Isn't it nice? Okay, learn to combine options and underlying asset to create trading strategy portfolios. That's what I told you. Either one option and one underlying asset, or combining a few options itself, or combining a few options with an underlying or two underlying assets. Well, we'll explore slowly. The third objective of this lecture is to learn how to draw payoff diagrams. Drawing payoff diagram is the blueprint of what you're going to do with the options which will put you into the profit region. In fact, it's a kind of a planning. You draw the payoff diagrams, you will see at what point the ST, the asset price, where it falls, whether is it above the strike price or below strike price, what happens if it's below strike price, how you can make profit, if above strike price, how you can make profit. And actually the drawing the payoff diagram is the nucleus of the entire strategy. Okay, of course, the payoff diagrams depends on the payoff tables. First of all, you must know how to draw the payoff tables. Fill up the payoff tables. Then from the payoff tables, you structure out the diagrams. It will be very interesting. Let us learn. And finally, one last objective here is to learn how to implement these strategies according to your requirement and objectives of the trade. Outline of today's lecture, we'll do a simple introduction. Then we will go into two basic combinations that covered calls. One call option combined with one underlying asset, or protective puts, one put option combining with one underlying asset. Both these strategies are actually kind of a replication for insurance strategy for yourself. That either way, if you are falling in the region of a loss, that underlying asset will help you to be floating in the profit, or it limits your loss. If you are in the profit side, both helps you to make profit. So basically, the idea of count calls and protective puts is to limit your loss and increase your upside potential to profit. Okay, then we will move into spreads. Spreads actually, why we call spread is because you're going to spread out your strike prices. In that, you have got three types of spreads. There is bull spread, bear spread, and the butterfly spread. You learn these three spreads. We typically call it spreads because we spread out the strike prices for more than one option. It can be a put option combining with a call option. It can be a call option combining with another call option where you short one and you long one. We'll see. Then, of course, the butterfly spread is there. Then we'll go into combinations. Combination is where you combine a few multiple options with multiple underlying assets itself. So you will devise the kind of strategy according to your requirement where price movements, uncertainties in price movements, that's why I say direction versus the jump in it, that is the volatility. Both side, you should not be in a loss. So we can create straddle where you have one strike price where you buy a put and buy a call at the same time. If the price moves that side up, the call will pay you. If the price falls, the put will pay you. Either way, you don't be in a loss. Then, of course, triangle, where we spread out the strike prices into two different spread, and you buy a call and you buy a put, and we see within the range where you can still make money. Then we go into summary. Okay. Last week, if you remember very well, we learned how to examine payoffs of naked option positions. Well, students are asking what do you mean by naked option positions? Naked option positions are just options alone without any combinations. Just it can be a long call or it can be a short call by itself, or it can be a long put or it can be a short put by itself. What does it give you? What kind of protection does it give you? Mainly in speculative nature. We are not combining it for the purpose of hedging yet. So it is naked option positions. Then last week also we showed the options. Actually, options are bets on both direction and volatility rather than just direction. Of course, you learned forwards. There are also derivatives. You have learned futures that both were talking about only directions, whether it will be in the bullish direction pricing or it's going to be bearish direction pricing. Only now, in the options, you're going to have another element that besides direction, the volatility also plays a part. What do you mean by volatility is the uncertainty of how much the swing of the price can be in either direction. It can be in the positive direction or negative direction. That's why we take the standard deviation of the underlying assets prices as the measure for volatility. And of course, later you learn there are two types of volatility, the basic volatility and the other one is the implied volatility. Right? In this lecture specifically, we will learn a range of strategies or trading strategies that we use options to bet either on direction or volatility or combined. Interesting, is it? Okay, let us go into trading strategies and portfolios. I'm sure you remember what are portfolios. Portfolio is a group of assets. If you manage it very well, it will be very beneficial to you. A well-diversified portfolios are there. Well, a trading strategy refers to a portfolio that consists of options on a given underlying asset and combining it with the underlying itself. That means you have an option on underlying, that is an option, it's a contract. And you also hold the underlying itself. So if the underlying price falls, options helps you to retain your profit. If the underlying prices go up, options help you to gain higher profit. There's kind of a synergy there. The strategy looks into creating a given target payoff profile. What is your objective? What kind of payoff do you want? Of course, most of us want to limit the loss and increase the profit. So we will examine basically, as I told you, covered calls and protected puts. They are the insurance concept, as I told you earlier. And then we go into spreads. We have got a bull spread, bear spread. Bull spread exploits the bullish direction of the underlying, and the bear spreads exploits the bearish price positions of the underlying. Then, of course, we have got the butterfly spread, which works to gain in either direction. Then in the third, we go into combinations. That, as I told you, we combine the number of options with the number of underlying itself. So where we can build straddles and of course triangles. We have got a few other combinations like box spread and all these things which we are not covering into this unit yet. You will learn it when you go to higher levels. These are the basic information which you need now where you can appreciate to use options. Okay, generally, three option strategies are available. Okay, let us see this carefully here. Three option strategies available. What is it? Number one, take a position in the option contract, either long or short, and also long or short the underlying itself. So this is how the covered calls or protective puts work, where you take a position in the option and substantiate it with the underlying itself. Number two, take a position in two or more options of the same type, maybe two call options or two put options, maybe different directions. One is a call or long call, the other is a short call, to create a spread where we can create a bull spread, bear spread, and a butterfly spread. The third strategy is combination. Take a position, a mixture of calls and puts, and also the underlying. A combination of straddles and strangle and all these things. Well, at this moment, you might be wondering what is straddle, what is strangle. These are the option terminologies which you will be using to identify what is the strategy you're going to do. Okay, the very important aspect of this lecture is that how to construct a payoff diagram. Based on my experience of teaching this unit many years, students initially find difficulties here. After going through the week 7 lecture, where I'm going to set a specific assignment for you based on this lecture itself, which will enhance your knowledge and make you a pro in drawing payoff diagrams and payoff tables. It's critical to be able to correctly draw the payoff diagrams for a given option trading strategy so that you know what is the strategy can do for you. Basically, what you should understand is where the final underlying stock price or whatever it is going to be at the maturity. We call it the ST. Where the ST is going to be at the maturity of the European option. Will it be above the strike or will it be below the strike? How far above the strike and how low below the strike? And what is your position? Are you in a call position or are you in a short position? Are you in a put position? If you are in a call position, of course, higher the ST above K gives you higher the profit. If the ST falls below, then you just expire it without exercising it. Of course, I told you, remember, options is just buying a right, not an obligation. You exercise the option only when you have money to collect or is profitable to you. Also helps to understand when to adopt which strategy. Right? My method is normally write down the payoff, the gross payoff functions first. Sketch out the gross payoff function first. Based on your strategy, what will be the payoffs? The payoffs depend largely on where the ST stands at the maturity point. And of course, the dividing factor is the strike price itself. When you have two different strike price, then you must see whether the ST is below the first strike price, or is it between the first and second strike price, or is it above the third strike price. This gives you a kind of an idea how to devise the payoff table first. From the payoff table, you can chart out a payoff diagram. That is why I write down the payoff function first. Number two, in my method, construct a payoff table that shows the value of the payoff function and different ranges of the underlying price at maturity ST. That's what I'm telling you. Where does the ST stops at the maturity? Based on these values, draw the payoff diagram. Well, we will learn it one by one. The net payoff diagram is simply the gross payoff diagram shifted downwards by taking into account of the cost. That's the premium you pay for the study. Of course, when you buy a stock, you don't pay any premium. But when you buy an option on that stock, then you have to pay a certain amount of premium. That could shift the profit payoff a little bit downwards or upwards based on what position you are taking in the options. If the cost is negative, then the payoff diagram is a gross payoff diagram shifted upwards, right? How come the cost can be negative? That means you are shorting the option and you are receiving the premium.